So let me start sharing my screen. And today I want to talk a little bit about sustainability reporting, which is my passion these days and where I'm spending a lot of time. So let me take you through a slide deck. And so basically, I'm going to talk about the sustainability reporting developments that are rapidly taking place these days, and sort of how do we address the credibility gap. And as you see, I'm a professor of accounting. And so I'm drawing from accounting how we need to bring some of the accounting discipline to sustainability reporting, because at the end of the day, both are reporting systems. So agenda, I don't think I need to spend a lot of time on the growing demands for sustainability reporting. As the poll indicated, everybody recognizes that this has become a critical function for most companies. Well, what I'm going to focus more on the developments in sustainability reporting and how are we going about trying to address the credibility issues surrounding sustainability reporting. All of you, I'm sure, have heard about greenwashing and kind of some of the cherry picking which companies are doing when they report about their sustainability performance. And I'll end with personal observations. I hope you'll find this useful. This is a topic which I'm really passionate about. I'm new to it, but this is a very, very exciting topic.
Sorry, Dr. Adhikari, to interrupt you.
Yes.
If you could just go into the full screen format. Right now we can see two slides on your window.
Okay. So let me see. Is it better now?
It's still the same. It's still showing the two. If you could just zoom in or, yeah, in the display settings, let's try that. Yes, and
is this better?
Yeah, much better. Right? Thank you so much. Thank you.
Yeah, that's good. Yeah, I was using two screens, so that was causing some confusion. So I think this should be better. So as the data is pretty clear, there seems to be a great demand for sustainability investing, for example, and the growth in ESG funds or sustainable funds has really skyrocketed. But as you observe, there has been a little bit of dampening in the recent years. And most of the demand is being driven in Europe, because Europe is kind of at the frontier of sustainability reporting. This is a survey from CFA, and this basically showing that more and more financial analysts are incorporating sustainability issues regarding environmental, social, and governance in their investment decisions. So a lot of this is being, a large portion, is being driven by the financial markets. Of course, the civil society is playing a great role in this demand also, but we can see in the finance sphere, there is a lot of hunger for sustainability information. So here I want to talk about the reporting system, because really I'm interested in what is the role of a reporting system. And the way I look at it, I look at reporting systems as performance measurement system. And so, if we think about our financial statements and financial reporting, this is a system designed to measure and report on the financial performance of economic entities, corporations, which we are going to zone in this class. So if we think about sustainability reporting, we can just put in the word sustainability, where a system designed to measure and report on the sustainability performance of corporations. So if we just think about, what the goals of reporting system is. And this is something all of us can relate to, because in every sphere, we are used to performance measurement system. If you're working, there is some kind of a merit and promotion performance system in place. If you're an athlete, there is some performance measurement system in place. If you are in an academic setting, then there's a performance measurement in place. And so here, when we think about it in terms of sustainability, what we are really interested in is how are we measuring and reporting on the sustainability performance of economic entities, which could be government, cities, and so on and so forth, or corporations, because we are in this business context. And we can also think about this as an information system. And what does an information system do? It basically measures, processes, and communicates the relevant information about corporations. So if we are thinking about financial reporting, which is what we do in accounting, we can put financial information over there. But if we are thinking of sustainability, we can substitute the word sustainability over there. So that is basically the role of a reporting system in very sort of broad terms. So I really like to see it as a performance measurement system. That is, we are trying to track and report on how well a company is doing on its sustainability initiatives. So why is this important? Because there are some agency issues in reporting. And so I've got these sort of tricky terms over there, but let me just kind of boil it down to a very simple analogy. So let's say, somebody comes to you, you know this person and says, okay, can you lend me $1,000? And you're going to think it through very hard. Should I give $1,000 to this person? Now, on the other hand, we easily invest $1,000 in the stock market. So we put 1,000. All of us, most of us must be investing, for pension, retirement, other goals in the stock market. And so we, invest in different companies. Now, of course, think about it. Do we know the managers who are running this company or the owners who are running this company? In most cases, no. There is a big separation between the management who run the company and the stockholders or the stakeholders of that company. So there is this, distance. So what is to prevent these owners, or managers, to take this money which we are investing as stockholders and just consume it themselves without really enhancing the returns to stockholders? And sometimes, we know sometimes this kind of thing happens, correct? We have the Enron cases, the Baizu case in India, and so on and so forth. So misappropriation of funds. But to a large part, there is confidence in the system, and the confidence really comes from the financial statements. And these financial statements basically help distant investors, creditors, and other stakeholders to monitor how well a company is doing in its financial performance, and also to influence and incentivize managers to maximize the goals which will benefit the investors and stockholders and other stakeholders. So the credibility of a reporting system is very, very important in the capital market. So if you don't have a credible reporting system which people can rely on, then you are not going to have that capital allocation that takes place in developed capital markets. So that is key. And so that is the thesis I want to build here. And so what provides this credibility to the financial reporting system or to any reporting system? One, there should be standards. So every company, when they're reporting on their financial performance, have to follow the same standards, same financial statements. In the US, we call it US GAAP, but in the rest of the world, companies are following International Financial Reporting Standards, or IFRS. So everybody is following the same standards. So that enhances comparability. I can compare one company's performance to another company, and also consistency. I can compare the performance of a company from one year to another year. Then we have statutory frameworks, so which are basically the regulatory bodies that ensure that companies are following these rules. Everybody is following these rules, and that gives added confidence to investors, creditors, and other stakeholders in making these decisions. There has to be a monitoring and enforcement mechanism. That is, if some companies are not following, there have to be penalties imposed and so on and so forth. So that is also important for a credible system. Then corporate governance. And corporate governance are the internal controls within the company, the board of directors, vigilance, the internal controls that a company has to ensure that the rules are being followed. And then very important is assurance, which is the independent audit, correct? Most all publicly traded companies have to have their financial statements audited by an independent auditor. And that gives enhances the credibility of the financial statements on which we rely to make these important investment and credit decisions. And then, of course, there is market discipline. The market also imposes discipline in many different ways. So these are the key pillars of a reporting system which makes financial reporting work. Now, when we move to sustainability, the challenges are manifold. One is sustainability is a huge area. So you have environmental issues, you have social issues, you have governance issues, correct? And environmental, we have the climate, biodiversity, pollution, waste, social human capital product liability, social opportunities, and so on and so forth. And governance is something which we are much more familiar with because it overlaps with financial reporting. Now, one is the scope of sustainability is huge. So in financial reporting, we are looking at financial performance, and we have one metric which we focus on. Everything is measured in the monetary unit. So it could be dollars, rupees, reals, or whatever currency we have. So we have one monetary unit. But when we look at sort of the ESG space, the metrics are very, very complex. So how do you measure, for example, carbon emission? And generally, you measure it in sort of, carbon dioxide equivalent in metric tons. So that is a complex measure. How do you measure something like social human capital? So we might have some sort of diversity indexes and things like that to measure some of that. So there are a lot of measures, unlike financial reporting, where we just have the monetary unit. You have a slew of measures in this ESG space to measure different, performance and activities of a company. And it is both qualitative and quantitative, which makes it even more complex. So the scope of ESG is much more wider and complex than what we are doing in financial reporting, which we have been doing for a long time. Now, the problem is there is a credibility gap as far as sustainability reporting is concerned. So the pillars on which sustainability reporting currently rests are very, very weak. And this is what I'm going to talk about. And that's why we have all these issues related to greenwashing and cherry picking that we see when companies are reporting on their sustainability performance. So the thesis which I want to sort of forward today is that we need to bring some discipline and rigor to sustainability reporting so that the credibility of the system is enhanced and stakeholders, all stakeholders, which are many, of course, they are the capital markets, the stockholders, the investors, creditors, but much more, the communities, the employees, civil society can rely on the information that companies are putting out in terms of their sustainability performance. And that then we can be a little bit more sure that the goals that we have set up as a society in terms of sort of the sustainability metrics are really being met. So that's why this is going to be very important. So let me quickly sort of take you through this. So first, in terms of sustainability standards, and this has been a major problem because most of sustainability reporting has been so far predicated on voluntary kind of standards. And there are many players that are there. So this is we call it the alphabet soup of sustainability frameworks because there are so many different frameworks and different companies are following different frameworks, so there's no comparability or consistency when we look at sustainability data. You have the UN, which has the SDGs. They are comprehensive standards, the Global Reporting Initiative, which is the voluntary framework which most companies, the majority of companies, are currently following. In the US, the Sustainability Accounting Standards Board, that those standards are have been followed. Then we had the integrated reporting. South Africa follows integrated reporting, and some of the big multinational companies follow that. And then we have a lot of area-specific standards. The Task Force on Climate Financial Disclosure, and now we have one on nature-related, and then we have a climate disclosure project, which is also very influential. So there are many different standards and frameworks which are available, but that really creates confusion and impairs comparability. So that has been one of the problems. Now, of course, one recent trend that we are seeing, there is a lot of consolidation that is taking place among this. And the three sort of most influential players in this space, first, I have to say, is the EU and the Corporate Sustainability Reporting Standards. And these are 12 standards they have issued related to sustainability reporting, which are going to be applicable for all EU companies. Now, why this is so important is that even though this is EU-based initiative and it is going to be required in EU countries, the scope of this is very, very large. So if you are a multinational and you're doing business in the EU, or you have a subsidiary in the EU, you come under this scope. So for example, 3,000 US companies, big multinational companies, are going to come under this ambit. So they'll have to follow this very stringent sustainability reporting standard. And similarly, a lot of big companies all over the world, which are doing business in EU, will come under this reporting ambit. So this is very, very influential. Now, we also have the International Sustainability Standards Board, and this is basically organized by the same group which makes international financial reporting standards. So this is part of that, IFRS Foundation umbrella, and now they have set up a special board to set sustainability standards which would be adopted worldwide. And so far, they've been very busy, and they have focused on climate first, and they've issued 2 standards which have to be followed. And in the US, we have a SEC climate proposal, which is pending, which is, when it is adopted, will become part of the regulatory scheme that we have. But at the same time, California, which is one of the largest states in the US, in terms of GDP, it will rank as 10th largest country in the world. If you just look at California, they have passed very strict climate disclosure proposals. Right now, they're being challenged in court, but if they succeed, the court test will become very, very influential. So hopefully there is some hope that now we are moving towards consolidation, where companies are going to follow one of the applicable standards. So that will enhance comparability and reduce some of the confusion. So a lot of countries have already started, looking at these proposals to embrace them in their national legislation. So, for example, the ISSB standards, Australia, UK, Brazil has announced that they're going to adopt these standards as part of their national reporting standards. The second is statutory framework. Of course, you have the standards. Now, the next thing is they need to be adopted by the national regulators. And we see that, there is movement towards that. Australia, UK, of course, in the EU, US, and many other countries, including India, and a lot of other countries in South America, Brazil, and so on and so forth, are now starting to think of putting some of these international standards into national regulation. So that becomes, now once they come into the national regulations, they become mandated. So it's moving from voluntary to mandated. And that's why companies are scrambling to get their house in order as far as sustainability reporting is concerned. Because once it becomes mandated, every company that comes under the ambit has to follow these standards. The next thing is monitoring and enforcement. I mean, you might have good standards, but if somebody is not monitoring and enforcing them, then it's not going to be really useful and credible. And so in financial reporting, we have all the national regulators which monitor. And of course, if some company is found to be negligent in terms of their financial reporting, there are penalties that are imposed on the company, correct? So we have the SEC mechanism in the US. All over the world, we have these regulatory mechanisms. And so currently, most of the monitoring is being done on a voluntary basis, generally by NGOs and activists. So I've got it on the top. There are a lot of NGOs and activists which look at the sustainability reporting quality, and then they are monitoring, they're putting out reports. So it's all voluntary. But now they're trying to start moving towards mandatory sort of enforcement and monitoring. So the EU has put out a lot of directives against greenwashing. The SEC has moved a lot of cases against companies which it thinks has been doing greenwashing. And similarly, regulators all over the world are starting to think about this space. So that is something that would also be important. Next is corporate governance, correct? All this is good, but unless you have an internal buy-in in terms of sustainability reporting, it's not going to be very effective. And so the tone has to be set in top, and that is, of course, the board of directors. The board of directors need to own it, that this is something important. This is something which the company has to participate in. It is required to participate in. And so that tone has to be set in top, from the top. And the second issue in corporate governance is internal controls. Whenever you are putting out a lot of data, you need to have internal controls so that data integrity can be maintained. And so in financial reporting, for example, companies have to have strict internal controls. And in fact, when auditors basically put out 2 audit statements for every financial statement, one is on the financial numbers that are being reported, is the company following certain standards? And the second is a statement on internal control, correct? A verification that the company has very sound internal controls, but through which the financial statements or financial reports are being generated. And so that is lacking. So this, I'm just showing some US kind of data, and you can see that the sustainability issues are really not very often being discussed in the board of director level, correct? So 30% respondents that never. So these are US companies that were surveyed, and 30% any sustainability issue was never discussed in the board of directors. Now, of course, this is changing as there is more scrutiny over sustainability issues, and we are moving towards a mandated regime. And the same thing you can see, this is on sort of internal controls. And so internal controls around sustainability reporting are fairly low, correct? Are fairly low. The highest is 64% on scope 1 and 2 emission data, but everything else is below 50%. So which means data integrity can really not be relied on, correct? Because internal controls really speak to data integrity. How is the data being measured? How it is being reported, and so on and so forth. And so if you don't have the internal controls, the data integrity is not going to be there. And this is something which auditors, independent auditors, look at very carefully. So naturally, the assurance space is very limited. So one of the big things why we rely on financial statements that are put out by companies is because we know that an independent audit firm, correct, basically goes through it and puts an audit report on every financial statement. And so that is a kind of a verification that the company has followed all the standards and reported, truthfully in terms of their financial performance. Now, that assurance is lacking. Now, of course, if you look at a lot of companies are putting out sustainability reports, but they are not independently audited for the most part. And even if there is an independent audit, it is very limited. It is not the full reasonable audit that we see in financial reporting. So, the credibility will suffer. And this is some data I sort of give you from a US sample of the Standard and Poor's top 500 companies in the US. And you can see 61% of those sustainability reports have no outside assurance or no outside. 36% have partial, only 3% have a full reasonable assurance, which is what we see for 100% of the companies that are putting out financial statements. So if I'm an outsider looking at sustainability reports, and if it is not audited or it only has partial audit, then the amount of reliance I can put on that report is going to be fairly limited. So this is one stumbling block. And part of it is that you can't get an external audit if your internal controls are not solid. And as we discussed, in the previous slides, that internal controls or data integrity is lacking so far in, sustainability reporting. Now, of course, this is an issue that, the regulators and the standard setters are basically addressing very, very quickly. Under the EU framework, limited assurance is going to be required, and it is going to transit to reasonable assurance. ISSB framework basically leaves it to the individual jurisdictions to adopt assurance standards. The IASB, which is the Internal Auditing Standards Board, they have actually put out an international standard on sustainability assurance. It is an exposure draft open for comment. So hopefully that will provide really good guidance, because there's one issue. One, companies are not seeking the external audit. Second, the auditors don't know how they need to audit these sustainability reports. So this is going to help, because it's going to provide guidance on how do you audit a sustainability report, which is in many sense different from what you do in financial reporting. And last one is the internal controls. And now COSO, which is kind of the big internal control group for financial reporting, has put out a report on how you develop internal controls over sustainability reporting. So a lot of people are looking at that. So there is progress on that side. Last one is market discipline. There has to be some market discipline also, correct? When I say market, I'm talking about capital markets and the markets at large. They impose discipline on financial reporting. So, for example, a company wants to raise, debt financing in the capital markets, correct? You want to raise debt in the capital markets. So what you need to do, you need to get a bond rating. Correct. You need to get a bond rating, and there are three big bond raters which rate companies based on their bonds. Correct. So, if you have really good financial health, then you might get the top AAA rating. So, which signals to the market that your financial health is very strong. And so you can raise a lot of debt capital in the capital markets at fairly low interest rates. So it's similar to what we think about our personal credit ratings, correct? If you want to go and, get a loan from a bank, generally the mechanism which we have is everybody has a credit score. These are companies which provide a credit score for individuals. And, credit card, or banks rely on that credit score to extend personal loans to all of us, correct? So it's the similar thing like that. Now, in this sustainability framework, because of the demand from the markets, we are starting to see a lot of ratings come which rate companies on their sustainability reporting. But the problem is there is a huge divergence among these. And I've just put some of the top rating agencies which are out there. But if you can look at, the ratings, there's a huge divergence among the different ratings, because all of them are following different methodologies. And of course, there's a lot of complexity in going through this sustainability reporting. So there is no convergence in ratings. So these are not very useful from that standpoint because, for example, if I'm looking at GlaxoSmithKline, the MCI is rating it below 0, while the Moody's is rating it at sort of a 2.5 scale. So the rating is very divergent. I don't know which one to rely on, correct? And so this divergence is really creating problems when we do that. So that in effect is some of the challenge that we are seeing in this sustainability reporting. So I'm just going to sort of end with why this is such an interesting area, correct? Is because there is intense regulatory action taking place right now. And so things are evolving very, very fast. We have new regulations. We have new ESG related products coming to market. Now we are moving from voluntary to mandatory, which is putting a lot of pressure on companies. So there is a lot of capacity building. So they are hiring a lot of people who have skill sets in this particular area. They're investing a lot on data and systems. And so the sort of high tech companies are now all scrambling to put out products to address this issue. And we are expanding to other areas like biodiversity and social impacts. The first focus has been on environment and climate, but now we're expanding there. So I think this is a huge area and strong demand for professionals with technical skills and interest in sustainability. I'm talking all the time to chief sustainability officers, and they are all ramping up very, very fast. So thank you. This is another beautiful shot of the Kogart School of Business, and this is how it looks like in spring. Okay, so thank you very much.
If you like this video, click the bell icon for more such